Are you wondering what's ahead for our property markets in 2023? In my mind, after a tumultuous 2022, investors must be prepared for even more uncertainty this year. But it'll be a year that our property markets reset, and it's the year that the new cycle is going to commence, meaning it, for some people, will be a time of great opportunity. Just don't expect it to be easy. In today's show, I'm going to share with you my expectations for the year ahead by discussing the major structural shifts that have led to previous property booms, and Brett Warren and I will discuss the property cycle, 8 reasons property values increase in the short to medium term, and I'll also explain 3 reasons why property values will increase over the long term. And I'll try and tie all this together to give you some expectations for the year ahead and help you make those important decisions homebuyers and investors need to make. Now, if at the end of today's show you gain some benefit, and if you don't already subscribe, please click the follow button on whatever podcast app you're listening to so you can receive an update every time a new show comes out. But for now, let's discuss what's ahead for property in 2023.
Welcome to the Michael Yardney podcast, where twice each week you will learn a number of new ideas regarding success, property investment and money in around 30 minutes. Our show is brought to you by Metropole, who specialise in helping you grow, protect and pass on your wealth through strategic property and wealth advice. Now here's your host, Michael Yardney, Australia's authority in wealth creation through property, who has been voted one of Australia's top 50 most influential thought leaders.
What's ahead for Australia's property markets? We're into a new year, which is no doubt going to bring its own challenges and its own opportunities. So to discuss what's ahead and to give you some idea of what's likely to happen in the short term and the long term, I'm joined today with National Director of Metropole Property Strategist Brett Warren, who's already a very successful property investor and helps many of our high net worth clients grow their wealth. Hi, Brett.
Hi, Michael. Good to be with you. And look, it is very interesting at the moment, isn't it? We've got the high interest rates and inflation is creeping up around there. And it's certainly eating away a lot of the average Australian household budget. And for some, obviously, it's going to make property less affordable. So a lot of questions I'm being asked, particularly the number one question is what's going to cause property values to increase moving forward? So I'd love to share some of your thoughts.
Now, that's a really good question, because if people are now at the maximum of their borrowing capacity, as a lot of people are, why should property values keep increasing? That's what people are wondering. And I believe they're going to, but in a fragmented way. And I believe demographics, such as our population growth, family formation, how we want to live, where we want to live, as well as the wealth of the nation, will be the main long-term drivers of our property markets. And I think they're going to be much, much more important than the short-term ups and downs of interest rates, inflation, government intervention. But Brett, while forecasting is difficult, especially about the future, I think history is instructive. So I think we should actually start, first of all, by looking at the past, even though it's only part of the story, but it's also important to look at the future.
Yeah, absolutely. And we've obviously experienced another one of those once-in-a-generation type of booms in 20 and 21 where I guess almost every property increased by 20 to 30%, didn't it? And, I've been through a few cycles, Michael. I'm old enough to experience a few of those. But, in these big property booms, it's always underpinned by some kind of bigger structural shift. And I've read a lot of your research, and I know it's gone back to 1970. So, unfortunately, I'm not qualified to talk that far back, Michael. So perhaps you can take over from here.
Yes. Look, I did experienced my first significant property boom in the 70s. I've been investing for 5 decades now. And then it was driven by high inflation. Hey, a bit like now. But just as importantly, in the 1970s, women entered the workforce. It was a different world, and banks started to accept women's income for serviceability. So all of a sudden, the average Australian household had 2 incomes, twice as much borrowing capacity. So suddenly the ability to borrow more led a significant property boom. Now, I didn't understand all that when I first invested. I just invested close to where I lived, close to where I went to school, close to where my mum went shopping. I was still living at home with my parents at the time. And a property boom carried me away. But soon I learned about cycles as well. And I think that's going to be one of the challenges that some people who bought the wrong properties a year or two ago are going to learn some lessons moving forward, Brett.
Yeah, what's the saying? Rising tide lifts all ships, but yeah, we'll certainly see who's swimming naked in the next couple of years, Michael.
Yeah, I think you're right. So that was my first big boom. Then in the 90s, we had the deregulation of the banks, and non-bank lenders such as Aussie Home Loans entered the market. And it all of a sudden made lending less restrictive. It was very difficult when I first borrowed money. I had to put on a suit and tie and sit with the bank manager. But all of a sudden, these non-bank lenders allowed people to borrow up to 95% of the value of their properties. This was unheard of before. Again, it increased the availability of credit, and that led to a significant property boom in the 90s, Brett. And then in the 2000s, we had a mining boom and created significant wage increases. So there were some of these quite important structural shifts. Each big boom, not the little booms, but those big ones like we just experienced, really occurred due to structural shifts, like in the late 2000s after the global financial crisis when we had another mining boom, but also Australia was suddenly seen as a preferred destination for foreign investors. And all of a sudden they invested in our real estate. They saw our economy as being stable, our housing markets as being relatively cheap. And this structural shift pushed up the value of residential real estate. And that brought us to the one you just mentioned a moment ago, the large, substantial boom of 2021, when once again we experienced a significant structural shift. Interest rates dropped to historic lows, significantly increasing people's borrowing capacity. But then there was also a raft of government stimulus packages, and they came at a time when there'd been a lot of pent-up demand because the markets were a bit restricted with the election of 2019, the Haynes Royal Commission before, APRA and ASIC's restrictions in borrowing. And that increased residential real estate values by up to $2 trillion just in that couple of years. But now that's over, Brett, and I don't think we're going to see another big significant structural shift for quite some time.
Yeah, it was a bit of a perfect storm, wasn't it? Everyone was saving a lot of money, paying off a lot of debt. And I think upgrading property, cars and caravans or boats were probably the order of the day. But
if you could buy one.
Yeah, that's right. And as you said, that's kind of moved on now. But what do you say? I'd be interested to hear your thoughts in what would be the next, or what's likely to be the next big significant structural change.
Okay, so I believe there will be booms and busts. I'm not sure exactly where they're going to occur, but that's what the property cycle does. But the next big significant one, to create a once-in-a-generation boom like we had, and I think it's really important for new investors to know that the experience of 2020 and 21 are unusual, very out of character for the normal property market, so don't count on the market doing the heavy lifting for the next couple of years. I'm not saying don't get into property. I'm saying you've got to do it with the strategic intention. But back to what's going to drive the next future structural shift, I think is going to be when the baby boomer generation dies off, and there's going to be a significant transfer of wealth. By the way, I've got no intention of getting away quickly, Brett. But having said that, when you see that the residential property market is worth close to $10 trillion, it's dropped in value to more like $9.5 trillion. But if you think about it, Brett, the majority of that is owned by baby boomers. Why? Because they bought their home years ago, they upgraded their homes, they've paid off their mortgages, they own investment properties. So it's suggested that there's close to around $6 trillion worth of wealth in their residential properties. And then, of course, they've got super funds as well. And my thoughts are when that gets transferred to their children and their grandchildren, which will probably be in the 2030s, so at least 10 years, but more like 15, 18 years away, that will again be a major change where people will suddenly have a lot of money. That's got to be strong for our property markets, Brett.
Yeah, it's interesting, isn't it? And it is a decade or so away, so it's quite interesting that people have got it right. They probably don't want to be waiting another decade or so before their property increases in value. So I guess that brings us back to the question, if anything, what do you see that will drive our future property price growth?
Well, the rising tide that lifted all ships in the last boom, as you said, has gone. As is the period of rising household income and low interest rates, incomes are going up a bit, but they're not keeping up with inflation. So we enjoyed that a decade ago, and it actually has led to that boom, meaning our property markets, I think now moving forward, are going to be much more fragmented. Moving forward, capital growth will be dependent on local factors, including what I said a moment ago, demographics, gentrification, neighbourhood people are going to want to and be prepared to pay. Some people are to live in the right neighbourhood, and wages growth of people in those locations, because there are some people whose wages are going up much more than average, aren't they?
Yeah, certainly. And they're obviously the areas we've targeted. And it makes sense because if they've got high savings rates and buffers, they're probably going to be able to recharge and get into that next cycle a little bit quicker, whereas other areas are going to take a lot longer.
Sure. And remember that the vast majority of people buying property are homeowners. And so they're not just investors, but they're going to want to upgrade their home, improve their lifestyle. Their families are growing up as well. And so they're also going to want to be living where the schools are, where the good neighbourhoods are, where their friends are. And the truth is the rich are getting richer. We're not going to even get into the social argument about that, but they're always going to be prepared to pay to live in the right sort of neighbourhoods, aren't they?
They certainly are. And Michael, we had a discussion a while ago, and obviously some people are nervous with rising interest rates and inflation at all different kinds of levels. And when I quizzed you about it, your answer was, I've seen it before. And we've got to remember it is just a cycle, isn't it? And I think that's what people who are inexperienced think it'll go on forever, or it's an extraordinary event, but in reality, it's really just another property cycle.
It is. Now, this was a significant one, but it's another cycle. So it's important to remember the market does move in cycles. And while the long-term trend is up, there are also periods when property values fall, and there are periods when property values remain flat, even for years. And I know you've written some blogs on Property Update, and Stuart Weems is also showing a number of charts about how over the long term, property values have increased significantly, and every cycle is followed by a downturn, but the downturns are shorter and nowhere near as significant as the upturn. I know that the latest statistics from the Australian Bureau of it was the Australian Bureau of Statistics, went back something like 45 years, and that's as long as they've been keeping track of median prices. And Melbourne property values increased by 8.2% per annum on average over those 45 years. Now, some years they didn't go up at all. Some years they fell in value. But over the long term, Melbourne property values increased by 8.2%, Sydney by 7.9%, Brisbane increased by 7.6%. Now, we know that if property values double every 10 years, they've got to increase by about 7% per annum.
Yeah, I think the key point to highlight there, Michael, as you said, that's an average. It's a pretty impressive average, but it still is an average. And of course, as we always talk about, there's not one Sydney market or Melbourne market, and certainly not one Brisbane property market, because there's always, I guess, markets within markets, and we're always trying to find the better areas, the better locations, whether it be for houses, apartments, townhouses, and villa units, as we've kind of seen. But they're all situated closer to the CBD in those inner to middle ring suburbs, and obviously then you move further out to the outer suburbs. So in amongst all of that, you've got to, of course, look at the regional property markets around Australia. And again, each of those have their own set of growth drivers and property price growth. So in reality, these long-term trends are interesting, but not very instructive. The devil's in the detail, isn't it?
Yes, it definitely is. And it is important to remember when you look at the long-term charts that after every boom, there's a period of flat or no growth, which can last a couple of years. Now, you, being based in Brisbane, have invested and lived through and helped clients through a number of those periods where, between 2011 and 2018, that was 6-7 years, the median price didn't increase at all. But I remember when we actually had client functions and you stood up there and showed case studies, you found that some properties well outperformed averages.
Yeah, and I think that's an art in itself, isn't it? Finding the right areas and the right locations, because otherwise your properties are just going to perform average, and that they may not grow for 5 or 7 years. And we saw that with Brisbane, with a lack of jobs growth and productivity, and a huge amount of oversupply as well. So, it's really about finding those right areas and right locations, as you spoke about.
Yes, it is. So finding gentrifying locations and also adding value. So this is a great time in the cycle. It's not as easy if you're not into it, or don't understand it, to add value through renovations or through capital growth. So let's first of all talk about what would cause property values to increase in the short to medium term. And then we can talk a bit about the long term, because Brett, a lot of our clients, and I guess a lot of people listening to this, are focused on the short term. They're looking for the next hotspot. They're looking for the next growth area. And while it's always nice to have that, at Metropole, we don't focus on the the short term. This year's hotspot will be next year's not spot. What we're really looking for is long-term growth. But let's go through some of them.
Yeah, certainly. Look, I always think, and I always talk to people as well, I mean, some of these short-term things are important considerations, but if you're looking to hold this property for 40 or 50 years, Michael, and maybe pass it down to the next generation, some of these points are probably going to be irrelevant in 40
You're
or 50
right, yeah.
So I guess, the biggest and most obvious one to start with, the reason of these property values increase in the short to medium term is probably interest rates, and it's a topical conversation at the moment, isn't it?
Sure. So while interest rates are important, they're by no means the only factor. So when interest rates dropped, there's no doubt that people had more money in their pockets, better borrowing capacity, and were able to borrow. So we're talking in general, the factors that push up property values in the short to medium term, and interest rates one of those. But the converse isn't always true. Just because interest rates go up, property values don't always drop. They have this time around because of other factors. In fact, if you look at 12 months ago, the property values started to drop in Sydney and then in Melbourne at the beginning of 2022, 3 months before interest rates even started to rise. So there are other factors. Apart from interest rates, though, it's also the availability of credit. In other words, how friendly the banks are, how they look at your borrowing capacity, what extra safety buffer they put on, isn't it? But I guess another big factor, Brett, would be supply and demand.
Supply and demand is probably the most critical, I think. And, certainly if you're buying in areas, and we saw in Brisbane as an example again, when we had that huge amount of oversupply of apartments, once demand for accommodation outweighs supply, obviously property prices are going to rise. But if supply outstrips demand, which we saw, obviously many prices are going to probably decline. So that's really important. You get an understanding of the immediate area, the type of property, because sometimes the property itself might be in a great location, but the supply and demand ratios aren't right.
Sure. So again, as we're going through the various factors that increase property values in the medium to short term, I think the supply-demand equation around Australia in general is very positive. In other words, there's just not enough properties, and that's showing up with few good properties for sale and the very, very low vacancy rates and the rising rents. Another factor is the availability and the cost of land, how long it takes to build new property. So if we're saying there isn't enough supply, why aren't developers producing more stock? Well, partly because the red tape, the green tape to get development approvals is one thing. But the other really is, at the moment, the cost of constructing something new is so high that it's not financially viable. So even a lot of the developments on the drawing board are not going to come out of the ground until the next level of prices go up again. And that's going to pull up the price of established properties.
Yeah, so there's a period there, isn't there? And there's obviously some supply chain issues as well that may appear to be resolving themselves, but we're still way away from that. So what about the general economic climate, Michael? Things like unemployment, inflation?
Yeah, all that affects people's ability to buy property. If they feel confident in their jobs, they're more likely to borrow. But I think that all boils down in one way to consumer confidence, and that's really been lacking in the last year. So while the fundamentals for Australia's economy have been pretty good over the last 12 months, our unemployment rate kept dropping, jobs were doing okay, businesses in general were doing okay, consumer confidence really tanked. But it seems to be improving, doesn't it?
Yeah, step by step. I think, there's, like we talked about, there's a bit of a shock there once interest rates had started rising. A lot of buyers and borrowers had probably never experienced rising interest rates and rising inflation. So I think there was a little bit of bill shock there.
Definitely. Sure. So as we discuss the various things that are going to impact property values in the short to medium term, another one's really government incentives. Just think back a while ago when the government had the home builder incentives. I mean, now they've got a funny incentive about building 200,000 homes a year, but they don't even know how they're going to do that. But when the government wants to inject more demand into that markets, it looks for incentives, especially for home buyers, and that broadens the pool of buyers that helps increase the price of properties, push up values by flipping the supply-demand balance, putting pressure on property values. But at the moment, most of those incentives are now worked their way out of the market. But again, the time will come when the government wants to help the economy, speed things up, and it knows the best way to do that is get first home buyers into the market, because when they do, then they got to buy refrigerators and carpets and televisions, and there's a lot of spin-off effect. And I guess the last thing, if we're looking at short-term factors driving the property market, Brett, is investor appetite.
Yeah, well, look, I guess longer-term investors make up about 30% of the market, but obviously in better times that stretches up, and in lesser times it stretches down. But it's interesting, is Michael, the poor old investors have been getting beaten up a bit lately, haven't they? We've had land tax issues in Queensland that thankfully have been resolved, and there's all these other measures and differences with banks and things like that as well. But I mean, the poor old investor are the only ones providing housing for the community at the moment. So will we see that shift in the short to medium term, Michael? Perhaps.
Well, you're right. I know a lot of investors are just wondering, is it worth it all? And we've seen that in the property sentiment survey that we ran, and Pippa ran one that in both cases we found that a third of investors, a lot in Queensland, sold up their properties. And some of them were worried about the land tax. Others were worried about just the extra rules as a landlord that they've got to follow. All that means, though, is that they haven't thought about the long term, because if other investors drop out, that's terrible for tenants, but for those who stay in the game, well, they're actually currently able to increase their rents. So I think one of the big challenges with property investing, and you said it a minute ago, is it's a long-term game, and people don't often have the right psychology. How often as a property strategist, when you do the reviews, do people come to you and say, maybe I should sell my property?
Yeah, a lot probably don't understand the reason behind it either, and don't understand how they're going to hold it for another 20 years when it hasn't been performing well. So it's very, very important to get an independent view, and quite often where we're sitting with people, Michael, we're actually looking for a long-term perspective. And I guess our next discussion is around the property values increasing over the longer term, and what drives those values. And again, thinking 20, 30, 40 years ahead, even more sometimes.
Well, before I answer that, just with regard to the people selling properties, I know as part of the strategic review you do when you sit with clients, sometimes you recommend it's necessary. And this actually isn't a bad time if you want to get set for the next cycle to actually just have a look and see, why isn't that property performing? Is it because it's just the time of the cycle and there's nothing you can do? Is it something you can do by improving it, by renovating it, by doing it up, or maybe even by changing property managers? Or is it a dud? And if it is, sometimes you just got to make that hard decision, don't you, Brett?
Yeah, it's a bit like a Band-Aid, Michael. Sometimes you're just best ripping it off and moving forward, particularly if it's going to hold you back. And look, we never make those recommendations lightly. We never make those recommendations without the facts and the data and the detail to back it up. So it's really important getting that independent decision and viewpoint.
Maybe it's a good time to just explain that when people come to see you as a property strategist at Metropole, you don't just recommend buying a property because we don't sell property, but it all starts by putting a strategic plan together and then looking at where they are now, where they want to be in the future, what assets they've got, are the assets going to help them get there, are their goals realistic, or what do they have to do to be able to achieve their goals? And as we said, we don't like selling properties, but all this is done based on evidence and numbers and facts and spreadsheets, Brett.
Yeah, it certainly is. And, it's really interesting when we actually take the plan to the clients and actually show them if they did nothing else today, where they'd be in 10 or 20 years' time. And I think we had someone the other day where we just made one or two really small changes. We recommend moving a property on, replacing it with a better property and adding another one. And they were something like $800,000 better off in a 15-year time frame. And information like that just can't be ignored when it's sitting there right in front of you.
Yeah. So you were talking about, I interrupted you because you asked what is going to affect property values in the long term. So we talked about the short term, but in the long term, and we're talking 10 plus years, as I said earlier on, demographics, which describes how we want to live, how many of us there are. It's not just population growth, it's also family formation, how many households there are going to be, but also how they want to live and where they want to live. And I think neighbourhoods become very important through COVID. So how many of us there are, and also the wealth of the nation. You can't find any country in the world that's got a good economy and that are wealthy where property values haven't continued increasing in the long term. On the other hand, there are some unfortunate, very poor nations around the world, Brett, where no matter how keen people are to live and have homes, the value of the property won't go up just because their economy isn't doing well and wages aren't going up. But there's a queue of people wanting to get into Australia. There isn't that in those underdeveloped countries. And the suggestion is that currently Australia's population is around 26 million. It's forecast to grow by 20 to 29 million by 2030. That means an extra 3 million people are going to live in our capital cities, particularly in Melbourne, Sydney and Brisbane. And by the middle of the decade, there's more likely to be another 10 million people added. And because these people have got good jobs and can afford to and will be wanting to live in the same locations, I see that as the big drivers that should give confidence for anyone who's playing a long-term game.
Yeah, so taking all of that into consideration, Michael, what is ahead for property values?
Well, again, as you said, the recent property boom was very unusual. All type of properties in almost all locations around the country increased in value, actually substantially. But moving forwards, I see our property markets being more fragmented. If you think about it, certain demographic segments are going to find the rising cost of living due to inflation, due to higher rents, higher mortgage costs, at a time when their wages aren't keeping up with inflation. That's either going to stop them getting into property or severely restrict their borrowing capacity. So this is going to impact negatively on the lower end of our property markets, which are also affected by many first-home buyers similarly having difficulty getting borrowing capacity. Many of them are still tenants wanting to get into those new outer suburbs, and the extra rent they're paying is going to just make it harder for them to save a deposit. In other words, there's going to be little impetus for capital growth, in my mind, at the lower end of the property market for a couple of years. But hey, that's not unusual. It's like we've seen in previous cycles. That's why I'd only invest in areas where the locals' income is growing faster than the national average. And I know you and I just recently pored over some spreadsheets that Kate Forbes and our research team did, looking at every suburb in Australia and looking at, I can't remember how many columns there were, and one of them was the percentage of owner-occupiers compared to tenants, population growth, the demographics, how their wages are growing compared to the average wage in the area. All that makes a difference. So we tend to invest in what I guess we call established money suburbs or gentrifying suburbs. These are locations where the locals have got high disposable incomes and they're prepared to pay a premium to live there. And as you said, many of them are in inner and middle ring suburbs, but it's actually not just the owner-occupiers, it's the tenants also, isn't it?
Yeah, that's right. And if you think about it, Michael, I think the key word there is established money in established areas and suburbs, because, you know, a lot of these newer suburbs, I'd say probably 98% of people in those suburbs have a mortgage and are you know, influenced by mortgages and interest rate. But probably, what would you say, maybe roughly about a third of people in these kind of established areas are, they probably don't even have a mortgage or a very, very low mortgage because they've been there for so long.
I think it's also a good point to make that in those outer suburbs and the new suburbs, and again, people have got to start somewhere. We're not knocking them, but don't look at them as investment grade. You've got a similar demographic, a lot of young families, many of them working class families, blue collar families. While if you go to those inner suburbs, you've got people who bought the house 30, 40 years ago. You bought people who bought the house 20 years ago who've still got a mortgage, while some of those who bought it many years ago have got no mortgage at all, as you said. And then there's going to be people who've only moved in a year or two ago. So you've got a breadth of people. So if the economy changes, goes up and down, and it will keep doing that, you'll always find some people who are in a good position, and they're the ones who are going to want to improve their lot by buying the right property and upgrading it. And in general, in those suburbs, it's going to be houses or townhouses that make good investments. If you can afford to, of course, we prefer recommending people buy house and land. But, you know, in Sydney, a lot of people can't afford that, and even in Brisbane. But more people are going to live in what we call townhouses, which is modern accommodation on more compact blocks because of neighbourhood. They'd rather be in a townhouse and in some cases an apartment close to the CBD and in a good location, as opposed to living further out where there are fewer amenities, even if it's a house and land.
It's really interesting you say that, because I think that's been a real shift in the Brisbane market, particularly in the last 2 years, where 4 or 5 years ago you could probably buy a house for 500,000 or 600,000 in quite a good neighbourhood in Brisbane. But now you've got to go 20 or 30 kilometres out, and you know it doesn't have the infrastructure, the walkability, and all those kinds of things you were talking about. So people were initially willing to get into a townhouse, and then the townhouse prices rose, And obviously now apartments are really performing quite strongly. So it's interesting we're seeing that shift play out here as well.
Well, if you think about it, with the increase in the population in Brisbane, Sydney and Melbourne, all our capital cities to a degree, but the large population growth is going to be in the big three capital cities because that's where a lot of the migrants are going to come. Most people aren't going to work in the CBD. Most people are going to have jobs in the neighbourhood and the suburbs. And that means, if you think about it, in the shops, in the schools, in the kindergartens, in the nursing homes, and what that means is infrastructure is going to creak. It's going to have difficulty. It's going to have difficulty coping with all the new cars, have difficulty supporting all these people. So neighbourhood and not driving far is going to be very important. And again, some people are going to be able to afford to choose the neighbourhoods they want to live in. The ones that not just got an IGA or an Aldi, but also got a Coles and a Woolworths, somewhere they've got access to gyms, to neighbourhood facilities, to sporting facilities. So that's that concept of the 20-minute neighbourhood that we've always talked about. But interestingly, school catchment zones are very important also for some segments of the community.
Yeah, it's interesting, isn't it? I mean, we see that up here in Brisbane. People are willing to sleep out to get their kids into certain catchments because they can't get in there. And one side of the road to the other with identical houses could be $60,000 or $70,000. So they are willing to pay a premium, particularly if the education comes at no cost and they can kind of put that towards their mortgage into a better location.
Yeah. So gentrification is another important factor to look at, one we look at carefully. In other words, where the older people are moving out and more affluent people are moving in. Now, this takes quite some time. So 20, 30 years ago, this was really the inner suburbs of our capital cities, and now it's more the middle ring suburbs which are gentrifying. So you're going to get the benefit of the general capital growth and then the local capital growth because the nature of the properties in that location are improving. And again, tenants are prepared to pay a premium to live there too. Some tenants are, and if you think about it, your future income is going to be dependent upon your tenant's ability to keep paying rent and paying higher rent, and that's why it's really important to look at demographics and the wages growth of potential wages growth of people in the neighbourhood. But then there's always that argument about, well, what about apartments? Should I buy an apartment when close into the CBD or a house way out, Brett?
Yeah, look, it's an interesting question, isn't it? But like I was just talking about before, I think, I guess certain lifestyle apartments are certainly becoming more appealing. We're not talking about the big high-rise apartments and inner-city blocks where there's not much scarcity and an outdoor is pretty much irrelevant in those kind of complexes. We're looking for more family-sized apartments or maybe something with a large balcony or a small courtyard in a small boutique complex because they've actually both performed quite differently, haven't they?
Well, they have. So when you take into account the overall apartment market growth and you look at the statistics, you're looking at the inner city high-rise apartments, you're also looking at townhouses, you're looking at older apartments and three-storey walk-up blocks. And in general, over the last decade, apartments have not performed as well as houses, even though in previous decades they have. But a lot of this has to do with the inner city high-rise towers where if you lump them all together, in fact, values have dropped from the price a lot of people paid for off the plan. So you're right, they've each performed differently. Now, it also depends upon where and in which state. So Sydney in particular has become much more apartment living centric, if that's the right word. People are much more prepared to live in apartments. Brett, when we have this conversation in 10 years' time, when I turn 80 and you'll still be a young man, I bet you we're going to be talking about how many Australians are living in apartments, because how are we going to fit those millions of people in if we don't have more medium and high density dwellings?
Yeah, we simply have to, especially in 10 years, maybe in 20 years, there might be some structural shifts, but certainly not in the next decade, that's for sure.
So what do you say to people who come to you, Brett, when you're a property strategist and they've already got their preconceived ideas, they've listened to other podcasts, they've listened to other blogs, and they say, no, I hear what you say, but I want to invest in those fast-growing outer suburbs?
Yeah, I think it's really important, and I sit them down and help them understand the difference between physical growth rather than capital growth. And I probably fell victim to this when I first started investing, Michael. You're buying these areas and, I guess 10 years, 20 years ago, there was sheep and cows living there. Now there's all these new housing estates popping up and a school will pop up, a Hungry Jack's, a McDonald's, and also maybe a train line or two. But then also, all of a sudden you get all this growth and the prices seem to rise, but then all of a sudden they open a stage 2 and a stage 3. And by the time they've opened to stage 5, Nobody wants to buy your property because it's 5 years old. And nobody wants to rent your property either because there's all these beautiful, shiny places around the corner. So there's too much of supply popping up and there's too much supply still to come out. So I'd rather get it the other way around where there's no supply. You can't just build another 1,000 houses and another 3 or 4 housing estates. There's going to be a cap on how much you can build, but there's a huge amount of demand. And as we all know, Michael, ample supply is the enemy of capital growth. We need to put a lid on that. So I guess understanding that closer to the big employment hubs, the CBDs, the big fast-growing hospitals, the airports and things like that is where the most demand for housing is going to be with employment and schools and education. And I guess from there, explain why we wouldn't move away from those types of things.
Sure. In other words, physical growth, the number of properties doesn't necessarily equate to capital growth. So we do a lot of research to try and find these locations. And I explained to the listeners a couple of minutes ago, the depth of research that our research department has recently gone into again. But it's a combination of the data, but also understanding what's moving forward in the future. So while, look, most buyers agents and many property strategists subscribe to CoreLogic, we've gone into it much more detailed and we've got our own proprietary analysis of it. And then I guess more important, things like your and my views of what's going to go on in the future about demographics, about economic growth, employment growth. So we don't just look in the rear vision mirror, we actually look forward to see about infrastructure growth, future supply and demand, and we actually look for multiple growth drivers. We've all seen the results in the past of if there's just been one or two growth drivers. The mining boom is an obvious one, but people buy because there's a new hospital coming or things like that. But if you've got multiple growth drivers, if one falters, there's other factors supporting your property's performance. Now, I know people tend to look at auction clearance rates and median prices. Auction clearance rate, in my mind, are a good in-time indicator, but the trends are more important. But I think one of the big mistakes people make, Brett, is look at median prices and just work on those.
Yeah, it's interesting, isn't it? And I always call that kind of technical analysis, Michael, because it's for that moment in time. It's a short-term requirement. And it's probably likely going to change in 6 months' time or 6 weeks' time. So, look, median house prices, I guess, are a little bit deceptive. You never want to buy in a median type of property or a median area. I know there's all these types of people that talk a little bit about, buying under the average and certain strategies as well. But I guess it doesn't reflect the activity in the market overall. So if there's a number of $1 million homes that come onto the market and sell in the last month, then obviously the price is going to go up. And the value of your home may not have changed at all, but it's saying that it is. And similarly, if the median house price falls in an area, it could just indicate that there were a lot more sales at the lower or cheaper end of the market as well. So it's not really. We talked about getting the devil in the detail. There's not as much detail there, is there?
No. So again, if a suburb has houses of varying quality, the median price isn't very useful because some properties are simply more valuable than others. So they're more likely to be a valuable measure in the outer suburbs where almost every house looks the same. But in my suburb of Brighton in Victoria, where I'm sitting at the moment, there are those houses near the beach, and then you cross over St Kilda Street and all of a sudden they're really nice houses, but they don't have a beach aspect. So that's a different price range. And you go a bit further, you've got some beautiful old Victorian homes, but again, within the same postcode, there are 3 or 4 different median price brackets, but they get all lumped together in the same postcode. So it really comes down to understanding your market. Look, in Sydney, I love saying if you're on one side of the street, you've got magnificent views of the Sydney Harbour and the water and the bridge. And if you're on the other side of the street, you've got magnificent views of the house that has views of the Sydney Harbour and water and the bridge. So median prices, while they're probably the most quoted figure and what a lot of people use to say this is where you should invest, it's actually really low down on our list at Metropole, isn't it? Because you can't lump all the properties together.
No, it is. And Michael, you've talked a lot about the visual things there, but there's some things that aren't so visible as well. And particularly in Brisbane, I'm in a suburb at the moment, which is a great suburb, but 30% of the suburb floods. And most people, and a lot of buyers agents come up here and crow about buying properties under market value or under median price, but it's in a flood area and you can't kind of see that. So having that perspective at ground level, not just for the visible things, but the things behind the scenes are also incredibly important.
Sure. So, look, we spoke a while ago in a podcast about his property investment, an art or a science. And if you're a new listener to this podcast and you haven't heard Brett's thoughts about that, hey, go back and listen to some of the past episodes anyway. And there's a great one about that, because it's not just data, is it? You actually have to have an on-the-ground approach. And that's very different to a lot of buyers agents who just fly in and out.
Well, it's interesting, Michael. I know how much you know about property, and I'm sure all our listeners do as well. You came to Brisbane, and what did you do? Did you go and do it all yourself?
No, your team bought a property for me, because I think a lot of people have what we call confirmation bias. They've already made up their decision about what they want to buy even before they come along to us or to other buyers agents or other property strategists. And that's not really the right way to do things. So we go into quite some detailed research. We use a top-down approach that we've discussed before. We've got a 6-stranded strategic approach. So when you sit with our clients after doing a strategic plan, I know that you use the frameworks I have fine-tuned over 5 decades, and together we've fine-tuned over a couple of decades to, I guess, give them an edge, to not just level the playing field, but give them an unfair advantage. So if you're interested in taking advantage of this window of opportunity that's occurring at the beginning of this new year, I think you should go to metropole.com.au and leave us your details. Find out about what we do and have a chat with Brett Warren. Brett, it's the beginning of a new year. Let's be blunt, we pre-recorded this and both you and I are on holidays when this is happening, but I hope you're going to come back refreshed and you're keen to see a few new people.
I will be very refreshed, Michael, absolutely. And I think there's some good things happening this year. I think interest rates will probably settle. Inflation will probably come back a little bit, and I think there'll be some opportunities. So I know a lot of our listeners may not be ready to pounce and buy property today, and that's a good thing. It's actually a good time to get all your ducks in a row, plan, prepare. You might need to sell a property or move some funds around. So I think it's a great opportunity to plan and prepare at the start of the year and to execute throughout the year when you're comfortable and when you're ready.
Well, really, buying a property, the property you eventually buy should be the physical manifestation of a whole lot of decisions you've got to make in the right order. Of course, that's not the way most people do things. They buy a property close to where they live or where they want to live or where they want to retire. And at this time of the year, a lot of people are going to buy properties in holiday locations, aren't they, Brett? Because the local estate agents call them ice cream lickers on the Gold Coast, because they come there with their cold ice cream and go in and buy those off-the-plan properties. But it's got to be done in the right order. Buying a property is not a strategy. Getting a loan from the bank's not a strategy. A strategy involves multiple factors, including an asset protection strategy, a finance strategy to help you buy time, a living off equity strategy, a capital growth strategy, a rental growth strategy. And that's what your team put together for our clients. And once that's all in place, then and only then should you find the property that will help you implement that strategy. So go to metropole.com.au, leave us your details, and Brett, I look forward to continuing having these regular chats with you throughout this new year.
Thanks. Should be a great year, Michael. Really looking forward to it.
Bye.
Bye.
Now here's Michael's mindset message. Remember, a change in your thinking will lead to a change in your life.
Where do you see yourself in 10 years' time? That's the topic of my mindset message today. And that's a good question to ask yourself at the start of a new year, isn't it? Where are you going? Because you know what? 10 years from now, you're surely going to arrive. But the question is, where? And we don't want to kid ourselves about that. We don't want to kid ourselves about the road we're walking. I learned a lesson from one of my mentors that I quote often in this podcast, Jim Rohn, who said that at the age of 25, shortly after meeting his mentor, Earl Shoaff, that was the name of his mentor, he had a day called Don't Kid Myself Anymore Day. He said, I didn't want to be disillusioned anymore. He said, I finally decided that crossed finger theory wasn't the way to get me what I wanted. It wasn't where the treasure lies. Jim Rohn said, I was going to have to make sure which way I was headed. And then he went on to say, then, with the help of his mentor, Mr. Shoaff, I found a few reading disciplines, a few disciplines of the mind, and a few disciplines of activity that, when exercised, can make all the differences to the world to where you'll arrive. But it took a few changes. And similarly, if you're going to want to arrive in a different spot in 10 years' time, you're going to have to change how you think, what you do, what you read, who you listen to, who your mentors are. Anyway, back to what Jim Rohn said. He said, sometimes we get the idea that we're doing 10% and there's 90% more that we need to do to make a difference to your fortune, but probably the opposite's true. Jim Rohn said we're doing enough of those things to have bought and shared in the good life. And maybe we just need an extra 5% or 10% of intellectual activity change, refinement of discipline, refinement of thought. And all we need is the idea to make those simple changes. And suddenly the equity starts gathering in 1 year, 3 years, 5 and 10 years. But now's the time to fix the next 10 years, said Jim Rohn. You have to come to grips with reality. And that's what happened to him when he met his mentor. He said he was 25 years old and his mentor was 44 years old. And he said, my mentor, Mr. Shove, brought me a wealth of experience. And he started by asking me the tough questions, big questions. He asked, are you reading the books that are going to take you to where you want to be in the next 5 years of your life? Now, that's a good question, isn't it? What are you reading? Who are you listening to? In those days, there wasn't podcasts, there wasn't YouTube, but there's so many wrong things. There are so many misleading things out there. So the same question you should be asking yourself, what are you reading? What are you taking in to feed your mind to make sure you're in the right spot in 10 years' time? Because to get where you want to be in the next 5 years, 10 years, you're either going to be reading the right books or not. You're going to be listening to the right podcasts or not. You're going to be watching the right YouTube videos or reading the right blogs or not. You're either engaged in the disciplines or you're not. But here's what you don't want to engage in. Disillusion. Hoping without acting. Wishing without doing. So the key message I want to give you today is to ask yourself, where am I? What could I do to make the change to ensure that I could be more certainly stepping day by day to the treasure I want, to the mental treasure, to the personal treasure, to the spiritual treasure, to the financial treasure? You should be saying to yourself, I don't want to make errors anymore. Now's the time to adjust my daily program to take me to where I want to go. So the key is to start right now by making the change to walk along this new road in this new year. Just a few daily disciplines will make a big difference. You don't need to change everything. You only have to change a few things, and before you know it, you'll be walking down a brand new road. I wonder where you're going to be in 10 years' time. Well, thanks for spending the last little while with me, and I hope you got some benefit from this show. If you did, and you know somebody else who'd also benefit, please tell them about the Michael Yardney podcast. There's a share button on every podcast app. On Apple Podcasts, there's 3 little buttons down the bottom. Press it and share it, or just tell them about the Michael Yardney podcast. I hope you're going to be doing them a favour, and you'll definitely be doing me a favour and helping me in my quest to make as many people as possible financially literate. Now, there's ways of catching up with me between these shows. Just look for Michael Yardney on social media, or why not join my private Facebook group? Go to Facebook and look for the Property Update Facebook group. And I have a way of saying thank you to you for subscribing to this podcast. Go to podcastbonus.com.au. There'll be a link in the show notes, podcastbonus.com.au, where you can get a bunch of ebooks and reports. My way of saying thank you. And when you've got time, why not listen to some of the old podcasts? There's individual lessons in each of those that I think would be helpful for you. I'll be back again real soon. In the meantime, have a great week. Make it a great week.
Thanks for listening to this episode of the Michael Yardney podcast, which was brought to you by Metropole, who help their clients grow, protect, and pass on their wealth through strategic property and wealth advice. If you like what you heard and don't already subscribe, you'll find us on iTunes or on your favourite Android app as the Michael Yardney podcast. Watch out for our next show, which comes to you twice a week, and you'll learn some new ideas about property investment, success, and money in around 30 minutes. To get more of Michael's thoughts, go across to www.propertyupdate.com.au and sign up for his daily morning briefing, and you'll hear from not only Michael but a group of leading property success and money experts. And just a reminder that the information you heard in this show today is general educational advice and not specific investment advice, as we don't know your personal circumstances. If you're looking for specific advice, why not ask the team at Metropole to help